How does implied volatility affect an iron condor? Are you curious about how implied volatility impacts the iron condor strategy in options trading? Let's break it down in a straightforward way. An iron condor is a neutral options trading strategy that combines selling an out-of-the-money call spread and an out-of-the-money put spread, all with the same expiration date. The goal here is to profit from a stock staying within a specific price range while benefiting from time decay and a decrease in volatility. Now, let's talk about implied volatility. Implied volatility is a measure of the market's expectations regarding future price movements. When implied volatility is high, options become more expensive. This is actually a good time to initiate an iron condor because you can sell those spreads for a higher premium. However, keep in mind that high implied volatility also raises the risk of the stock moving outside your desired range, which could lead to losses if the options become in the money. On the flip side, when implied volatility is low, it's usually better for the iron condor strategy after you have set it up. Lower implied volatility means there is a reduced chance of large price swings, which increases the likelihood that the stock will stay within your defined range. Additionally, a decrease in implied volatility can lower option premiums, which is helpful if you need to make adjustments to your strategy later on. The timing of these volatility changes is essential. The success of your iron condor largely depends on the stock remaining within the range and implied volatility decreasing over time. If you notice an unexpected increase in implied volatility after you have set up your iron condor, be aware that this can heighten the risk of losses, as it raises the chances of the stock moving beyond your range. When you consider initiating an iron condor, it is often advantageous to do so when implied volatility is high. This allows you to collect more premium upfront. However, always keep an eye on implied volatility and be ready to adjust your strategy if needed. Adjustments can include rolling the spreads or extending the expiration date, which can help manage risk and potentially increase profits if implied volatility decreases. In summary, understanding how implied volatility affects an iron condor strategy is key to making informed trading decisions. High implied volatility at the start can boost the premium collected, but a decrease in implied volatility over time is what you want for maintaining profitability. Always be mindful of volatility risks as you navigate this options trading strategy.